Hello, I'm Tony Boyadjian. Welcome to Compass Global Markets Weekly Foreign Exchange Update. The US Fed is in no hurry to raise interest rates. We've seen the US dollar sell off. It's reached a 4-month low, and it's due to the gradualism in the Fed's tightening policy cycle. The Trump reflation trade seems exhausted. It looks like the US dollar will continue to suffer this week, and the dollar yen will probably be the main beneficiary. We're looking for a test of that 108 support level on dollar yen on safe haven plays. Now, investors and companies alike tend to prefer to make business decisions based on fundamentals. And what we've seen is with the repealing Obamacare was to free around about $500 billion from the US budget to help fund the tax cuts that they were planning. Now that the Republicans' healthcare bill vote in the US House of Representatives is cancelled, it means that, well, it throws a spanner in the work first of all, but it means that it can undermine the US budget. And this may slow US economic growth going forward. It can also cause the Fed to pause its interest rate hiking cycle, especially if the US border adjustment tax is implemented. Now, we know that US President Donald Trump's plan is simply to cut the US corporate income tax rate from 35% to 15%, but the congressional Republicans, their plan is to implement this so-called border adjustment tax, the BAT. Now, it's a tax on imported goods, but also includes a tax break for exported goods. Now, this is forecast to raise $1 trillion. Now, the US Freedom Caucus, this is the group of conservative Republican congressional members of the House of Representatives. They're the same group that didn't vote for the repealing of Obamacare. They're against the BAT. So we may see this shortfall affect the US budget, and it can worsen the situation there. And look, we can see a recession. A recession now is possible in the US next year or the year after. Tomorrow we have US consumer confidence figures out for March. Now, it'll be keenly awaited, because if it's a weak number, it means that market sentiment will slump further. It also means that volatility will increase, and it will drive down asset prices. We expect the US dollar to remain weak this week and correct lower in the absence of any market-moving economic figures. Now, if we put our attentions locally here in Australia, the Reserve Bank has warned of threats to the property market, in particular rising household debt levels. The debt-to-income ratio of 187% is a record high. The RBA is reluctant to move on interest rates this year, and so we'll see the official cash rate remain at 1.5% for the course of this year. Meanwhile, Australian banks are doing the dirty work for the RBA in terms of raising their interest rates on investor loans and owner-occupied loans. In fact, nearly 60% of all Australian loans written in the last 6 years are interest only, and this is what the RBA is concerned about. So in terms of the Aussie dollar for this week, the risk is that if inflation continues to rise and interest rates, especially those home loan rates, continue to edge higher, then the risk is that the Australian property market may suffer a major blow. We believe the Aussie dollar this week remains vulnerable to the downside. Look for 74.5 cents support, and on the top side 77 remains firm resistance as the risk-off trade prevails. Elsewhere, we expect the euro to be range-bound this week. Now, the euro is currently trading at its highs of this year, but the risks have started to shift away from more ECB monetary easing. Meanwhile, we've seen the French political uncertainty ease as well, and lately we've seen some upbeat European PMI data. Trusted surveys of business activity rise to 6-year highs. And given that the Eurozone economy is recovering, the recovery there is only really just starting, we believe there is no reason for European interest rates to rise. Now, the market will be waiting for Friday's March CPI figures. Our forecast is for that to be around 1.8%. Elsewhere, we see in the UK, I'm bullish the sterling pound. I've turned a bit bullish on the sterling pound, because the question now is being asked is whether the invoking of Article 50 becomes a hurdle or a tripwire. It could be a sell the rumour, buy the fact scenario, and the market is very bullish on the sterling pound, and we could see a retest of that 127.75 resistance level. Now also on Friday we've got some current account figures coming out in the UK. These will be carefully watched because an improvement in the deficit number from 25.5 billion that we saw last quarter to the current quarter, say Q1 expectations of around 16 billion pounds, will also help strengthen the sterling pounds. I'm Tony Boyadjian, Compass Global Markets.